Pleasure to be here. As Larry indicated, we're going to spend the next few minutes doing a couple of things. We're going to talk a little bit about a research project that we conducted on behalf of the Cattlemen's Beef Board, looking into beef demand, and then we'll spend a few minutes talking a little bit about where we see the cattle markets headed here over the course of the next year, maybe the next year and a half or so. So to start off with, let's just look at the demand picture. This is the beef demand index that I maintain on behalf of the Beef Board. The index starts at 1980, so we've indexed against 1980. So retail beef demand in 1980 is our base year, and the index values across time indicate the percentage of retail beef demand that existed in a given year relative to that base year. And so you can see the big demand decline that occurred as we moved through the decade of the 80s and the 90s, bottoming out in the late 1990s at about 1/2. And just to stop and think about that for a second, what that implies is that retail beef demand in the domestic market in 1998 was about 1/2 the level that existed in 1980. And if you think about all the challenges and difficulties we've faced in this industry over time, a lot of it's traceable to that large precipitous decline in domestic beef demand we saw over time. It's very difficult to survive in an industry with that kind of a demand decline underway. The good news on the right-hand side of that slide is that beef demand in the domestic market started to improve in the late 90s, topping out in about 2004 with an index value of about 63, and then the last several years we've lost some ground again. And so our challenge with respect to the project we conducted on behalf of the Beef Board was to go back and look and see what was taking place over that time and see if we can explain why those demand shifts were occurring, because the index is designed to measure the shift in beef demand that occurs year by year, but it doesn't really offer us any explanation as to what was behind those shifts taking place over time. So our challenge was to build some models that helped us explain the shifts in demand that were occurring throughout the 80s, 90s, and the first few years of this decade up through 2007. So the factors included in the analysis, beef quantity and price, competing meats and other goods, consumer expenditures, and then some non-traditional beef demand shifters, namely food safety, health, nutrition, and convenience factors. So let's just take a look at that for just a bit. And I thought it would be interesting to go back and just look at what's taken place with respect to income and expenditures, because that is a big driver of beef demand. So I want to take a look at personal disposable income and personal consumption expenditures going back to the early 1980. And these are aggregate values, so those are $1 trillion on that vertical axis. And if you look at the growth that we've seen in disposable income since the early 80s, it's been dramatic. Disposable income in the U.S. in the early 1980s, a little over $2 trillion. By the end of 2007, 2008, we were up over $10 trillion. If you look at the change in personal consumption over that time, it actually looks a lot like that disposable income chart that I just showed you. In fact, as you look at that, your first reaction, I think, is to think that when U.S. consumers get an additional dollar of income, what do they like to do with it? They like to spend it, don't they? But it turns out, actually, they like to do a little more than just spend it. And we'll see that here in a second. But as you look at the right-hand side of that slide, you can start to see the recession getting underway in the tail end of 2008. All right, looking at those downturns in both consumer income and consumer expenditures. And when you look at the life of that graph, we don't have much evidence of that taking place previously. So we're in a different zone than we've been in the past, right? We have not been in an environment where we were seeing income and expenditures turn down. We are at the moment, and that's likely to continue going forward. Well, I mentioned a minute ago that consumers like to spend an additional dollar of income when they get it. Let's just take a look at that. I want to take a look at the savings rate expressed as a percentage of disposable income over that same time frame. And as you look at that savings rate in the early 80s, keeping in mind this is quarterly data that likes to bounce around a lot, in the early 80s was ranging between about 8 and 12%. And as we headed through the 80s into the 90s and the first part of this decade, what happened to that savings rate? Essentially went to zero, right? We actually had one quarter with a negative savings rate, meaning that we were spending more than we were actually earning. And as you look at the right-hand side of that slide, though, you can see what's taken place. That savings rate has really started to increase the last couple of quarters. And I've got a preliminary estimate on there for the first quarter of this year based on the January data. That savings rate's gone back to 5% in the month of January. And that's very significant as we go forward and think about our economy and think about demand for consumer goods, and beef included, because in the short run, a dollar that goes into savings is not a dollar that's available for consumption. As that savings rate goes up, we've got fewer and fewer dollars available for consumption, and that's exactly what's taking place right now. In terms of forecast, you can look around and find various forecasts for where that savings rate might go, but there are a number of economists that think that we might see the savings rate go back to the levels we saw in the early 1980s. In other words, that 8 to 10 to perhaps 12% range. That has a pretty negative impact in the short run on consumer demand for a wide variety of goods, and beef is one of them. So looking ahead here over the rest of 2009, 2010, we've got some challenges ahead of us. And you can see this when you look at, in this case, it's expenditures on food at an annualized rate going back to the early 1990s this time. And that's the percent change year upon year starting in 1990. And as you look at that, there's a lot of green bars on that graph. You look at the right-hand side and you see a very large red bar as showing a decline in that consumption expenditures on food. And as you look at that, we're again in a region or a zone that we have not been in for a long, long time. In fact, on that chart, we've never been in it before, going back to 1990. So that kind of suggests the challenge that we're facing in terms of consumer demand for beef. And I think looking ahead over the next, the rest of 2009, and I think probably spilling over into 2010, the odds are very high that we're going to see some declines in consumer demand for beef at the retail level, not because of what we're doing in the beef industry, but rather because of the response we're having to absorb relative to what's taking place in the macro economy. So I think as an industry, we need to recognize we're probably going to face some declines in demand this year, and I think spilling over into 2010. But from a longer-term perspective, what we want to do is perhaps keep our eye on the prize and focus on the things that we can do in this industry to have a positive impact on beef demand going forward. So with that, I'll turn it over to Ted.
Thanks, Tim. So if consumers are pulling away from food expenditures, they're spending less. It doesn't mean they're eating less. In fact, what they're doing is reallocating the food expenditure budget. And this is, very much a short-run response to the current economic conditions. But as we look at what this is doing to our food industry, we can really quickly get a sense by just observing over the last year what has been happening to some of the food industry companies. And first here, if you look at McDonald's over the last little over a year, a stock price that's been stable. So if you had invested $10,000 in January of 2008, you'd still have roughly 10,000 McDonald's. That doesn't sound like much of a high return, but it's incredible given that the S&P, or the Dow in particular, the larger index of major stocks across our economy, has been cut down to nearly in half during that time period. So we're ratcheting down to some of the lower cost, lower valued protein sources. In contrast, our higher valued food sources, such as Whole Foods, the higher end steak restaurants, they have suffered tremendous wealth loss, value loss during this time period. Pure, clear evidence that consumers are ratcheting back where and what they're spending their dollar on. And obviously that has a huge impact for our industry, especially for the higher end cuts and their value opportunities, as well as for the higher quality grades. And we've seen that recently, where we've got not much incentive in the industry right now to target products for that market. That is, the clear driver of how important to us the consumers' demand driven by expenditures and consumer incomes are, and by their savings rate and the trade-offs amongst those. We need to recognize that. We need to be aware of it. It creates volatility in our industry, and it's one we face every day as you go out and entertain and engage in this market. But it's not one you have a whole lot of control over. But all you can do is try to manage around it, or manage given it, and understand the dynamics going on there, understand what it means for you as you go forward, but recognize that's about all you can do. You can't change those economic factors that are occurring. You can just respond to them. But as we looked at a lot of the other demand factors that we found to be important determinants of demand for beef drivers over time, a lot of these others, we found some things that were very important drivers that you actually can have and do have influence on. And I want to spend a few minutes here visiting with you about those before we move on to the Outlook final session. One of the factors we examined in our study was the food safety factors and the things occurring in the industry relative to food safety perceptions and concerns. Jim and I and some others have done quite a bit of work just on how consumers perceive food safety issues in the beef industry. They are critically important to our consumers. They are especially critical to market access in international trade markets. We have some food safety issues that the industry needs to continue to spend time and resources trying to resolve. It was quite a discomforting at best situation in 2007 when we reached record high levels of recalls in the beef industry. These recalls gradually chip away at our consumers' confidence. They lose the confidence in the product. They begin to become concerned about the safety of the product, and our demand analysis says these reduce beef demand. In 2008 here, we ran about the same level of recalls as we were in 2006, so fortunately that spike in 2007 looked like it was a bit of an aberration, but that spike alone, that increase from 2006 into 2007 caused about a 2.6% decline in beef demand alone. So food safety driver is one we've got to be very diligent in this industry. Every player in this industry has a place in that food safety issue. And the challenge with food safety, of course, is product can be perfect when it leaves the ranch. It can be perfectly safe when it leaves the stocking operation, the feedlot, even the packing plant, and it can be contaminated or introduced with some contaminant later in the process. So the challenge with food safety is that the entire vertical food chain, from the final food preparer all the way down the system, has some opportunity to influence that safety. It means we really have to work from a very vertical coordinated effort to help reduce food safety issues. And we have to. Because again, first of all, we know they're market access drivers. Second of all, consumers care about them and are responding to them in their demand responses. Another major factor that is becoming increasingly important to our consumers is health information and health-related attributes of our products. Nutraceutical has been oftentimes used as one of the words that we're hearing show up in a lot of places. Consumers increasingly are concerned about this. We monitor several different indexes to try to understand what's happening and what our consumers are being exposed to out in the retail shelf and in the food service areas. And health information indexes are one of the ones that we've watched over time. In particular, this one is the number of articles published in the medical professional journals relating red meat consumption, fat, cholesterol with heart disease and arterial sclerosis. That trend from 82 up until the mid-early 2000s was a continuous upward trend. Now, we've had a bit of a decline in that recently, that is not nearly as prominent as it was. Our research says this trend continued to chip away at beef demand throughout that time period. This benefited a little bit, but that's still a large food or large health concern related to beef that needs to continue to be researched, continue to be understood, and then the industry figure out ways to make sure the product we're offering is not, in fact, contributing to excessive heart disease concerns, or that consumers that have that recognize which of our products are better suited for those diets and which of our products are less well suited. That is a continual investment in educating and providing information to our health professionals, our physicians, and our health dietitians. They're the ones that take this information, convey it to the consumers, telling people what they should or shouldn't do in their diet. If they don't get the information, the health professionals, the consumer doesn't get it, or the consumer gets the incorrect information. So it's critical that we continue to invest research in better understanding the nutritional or the health aspects of beef and the impacts that we can have on that. that issue is one the industry is continually needs to invest in. And I think as you hear both Jim and I speak here today, what I hope you'll understand is there is no simple, easy fix here. We're going through several different factors that if you ignore one, and this is an example, if you ignore any of these, food safety, or you ignore the nutrition or the health aspects of beef, it chips away at demand, and we can have some impact there. So continued investment in that is quite important. The beef industry benefited a bit from the Atkins craze. You know, that was a short-run phenomena. We said when we saw it occurring, we were fearing it was a fad. Indeed, it was. It benefited a little bit. It wasn't a huge infusion of wealth into our industry, but the industry benefited a bit. Atkins is gone now. And in fact, now if you look at the press, and we've watched the index on Atkins, there's more negative press on Atkins and the ill effects of that diet than there are positives. So that one's gone. We're not going to gain from that. But instead, there is some positive news related to beef in the nutrition area. And in particular, the zinc, iron, and protein literature is expanding rapidly. One of the indexes we also follow and have analyzed its impact on beef demand is the number of popular press articles that are coming out to our consumers on the importance of increased zinc, iron, and protein in our diet. This is a pretty significant increase of about three to four-fold increase in the number of articles that are out there coming out supporting those linkages, increased zinc, iron, protein in the diet, and better health. That's something the beef industry has a strong comparative advantage to take advantage of, to present and position the product with the characteristics because the product offers considerable amounts of those nutrients. So that's another opportunity, and this clearly is impacting beef demand according to our analysis, and one that we see opportunity for the industry to continue to invest in knowledge, invest in product development that meets and helps consumers understand the opportunities that beef presents with respect to those nutritional attributes that increasingly are demonstrating to be more and more important to lifestyle or to human health than maybe we once thought. So a lot of opportunity we think there to continue on that. That is not a fad. That is a longer term kind of pattern and investment in knowledge in our consuming segment. Another one that we all have spent a fair amount of time in the industry, has already invested a lot in, but needs to continue the momentum with, is developing new products that meet our consumer lifestyles, the convenience factors. We've looked at a lot of different dimensions of convenience, product development attributes. One of the ones that just provides you a sense of the demand for convenience, and this is just one amongst many that we could show, this is just the upward trend in consumers eating food away from home. Since '82, they've gone from a little over 40% to about 48%. It's getting close to half of our food being consumed away from home. That's just one measure of food product demand for convenience, for products that are convenient and easy to prepare. This is also impacting beef. Unfortunately, our industry, the beef industry, has lagged behind, particularly poultry, in product development. And in fact, if you look at some of the numbers that come out of some of the reporting organizations that track new product developments, in '08, the beef industry had about half, in fact it was under half, as many new products entered into the shelf, the retail counter, as did poultry. That little bird had twice as many new products entered onto the shelf in 2008 as this enormous carcass. We just need to continue to invest in that. That is critical. New products that offer convenient attributes to that consumer are absolutely critical, and the industry has lost ground on that. In addition, if you look at the hotel restaurant institution service offering, we are actually losing to the poultry industry there as well. They have developed more products, and our analysis says that as eating away from home has increased, the beef demand has actually suffered relative to poultry. Poultry has benefited considerably more there because they have offered and developed products that are more conducive and more quickly adopted by that industry than our products. So again, I think it's imperative that the industry continue to invest in that, continue to develop products and continue to work with the HRI to determine products that meet their needs and will enhance their profit as well as help the industry grow. We have just spent lots of time and energy on this, and it needs more. Because like I say, the other industries aren't stopping and waiting for us, particularly poultry, and of course pork is well poised as well and has had a lot of product development as well. So that is an area that our results say is critical, and I think we've spent more time probably thinking about just product at the retail counter. We need to make sure we're investing at the hotel restaurant because that's where considerable amount of consumer growth is going on in that demand sector. So I'll turn it back to Jim to wrap up with the cattle outlook.
Thanks, Ted. Let's turn our attention to the outlook for just a bit. I want to start off with a graph of cow-calf returns based on the Kansas Farm Management Association data. These are returns above variable cost, and they're through 2007 because we don't have the 2008 data yet. That won't be available until later this spring. But as you look at it, we've had a nice string of positive returns above our variable cost for going back several years. But you can see the decline that we've seen relative to where we were just a couple of years ago. In fact, those returns have really dropped back. In 2007, we were about $150 a head below where we were in 2004 and 2005. The data for 08 is not available yet, but I think it's going to be red, meaning that we probably did not cover our variable cost of production in 2008. And I think the same is going to hold true in 2009. So as we look ahead here, I think our problem is going to be that we're going to have some tough times looking ahead the next year, maybe the next couple of years in the cow-calf business. And as you look at that, of course, that's been feeding right back into cow slaughter. We're reducing the size of the herd, and that's been going on for some time now. We've had 3 years in a row with significant increases in cow slaughter. I think in 06 we were up about 12% compared to the prior year. 2007 we were up 6%, and then in 2008 we were up about 9%. If you look at female slaughter so far this year, female slaughter, not just cows, but females in total up about 5% in 2009 versus 2008. Now, admittedly, a big chunk of that increase in early 09 is coming out of the dairy sector as opposed to the beef cow sector, but still, over time, reducing the size of our herd in total. And if you look at the beef cow inventory, you can see that the January 1 inventory was down about 2% compared to a year earlier. That follows a year earlier, and we were down around 1% or so. Looking ahead 12 months from now, I think we'll look at another decline in the size of that beef cow inventory. Of course, where that takes us is on the supply side, gives us some smaller slaughter numbers. As we look at prospective slaughter here in 2009, probably about 33.5 million head, give or take 100,000 head is where we're probably going to wind up. 2008, we were over 34 million head, so we're bringing the slaughter numbers down. That means smaller beef production numbers over time and feeds back into smaller supplies, but that's also going to be dependent on what takes place with respect to trade. And if you look at the trade side, that's been, as Neville pointed out this morning, one of our big positives has been what's taken place in the beef export arena. But as you look at where we're headed in 2009, I think the odds are pretty high that we could actually see a modest decline in beef exports. If you look at what took place in 2008, on an annual basis, we were up about 32% compared to 2007. But if you start looking at the monthly data and seeing how that was unfolding, the big increases in percentage terms were in the middle part of the year and the early fall. By late fall, we were looking at some pretty small increases on a year-to-year basis. I think beef exports in the month of December were up about 14 or 15% compared to a year earlier. And I think the trend is in place as we move through 09. We're likely to actually see those beef export numbers fall a little bit below where they were in 2008. Maybe see some recovery as the world economy maybe starts to improve in 2010, but probably not much before then. Where does that leave us in terms of beef supplies facing U.S. consumers? These are per capita beef supply estimates from USDA going back to 1990, and you can see the big drop in 2008 versus 2007. 2007, we were up over 65 pounds per capita. 2008, less than 63 pounds per capita. 2009, probably coming down a little bit. It would be coming down more than that if we had a little better export picture, okay? But with the exports maybe backing off a little bit, only a modest decline. But as you look out to 2010, as those slaughter numbers continue to decline, we're going to see those per capita supply numbers come down even farther and maybe fall all the way below 61 pounds per capita. As you look at the other competing meats, we've got a similar story going on. On the pork side, pork numbers coming down for two reasons. One, on the production side, and also because the pork trade, the pork exports have held up better, much better than the beef side. But still, smaller per capita supplies on the pork side. In fact, when you look at it across the board and look at all meats and the broilers as well, per capita meat consumption coming down markedly in the U.S. And I think it's important to look at those numbers for just a second. If you look at where we were just a couple of years ago, we had per capita meat consumption in the U.S. over 220 pounds per capita. In 2009, we're going to be about 212, 213 pounds per capita. And in 2010, we could easily see per capita meat consumption drop below 210 pounds. That's important because as you think about what's taken place in our industry, we're experiencing some difficult times in 2009 and I think spilling into 2010. But when demand does start to improve, as the U.S. economy starts to recover, and as other economies around the world start to recover, we're going to recover from a very, very tight supply base, not just in the beef sector, but across all the meats. And in the past, that's created the potential for a very, very strong recovery in meat prices. So looking ahead, there is some light at the end of this tunnel if you're in the cow-calf business. I think we're looking at difficult times in 2009 and perhaps in 2010. As you get out to 2011, as we start to see the U.S. economy and the world economy recover, we'll be recovering from that tight supply base and probably see a pretty strong recovery in calf prices, fed cattle prices across the board. If you look at a more detailed forecast, this is one of the charts we put on our Ag Manager website every Friday afternoon, where we take the settlement prices from the CME and then adjust those for basis levels and use that to generate a series of monthly price forecasts. So these are essentially futures-driven price forecasts going out to roughly the middle of 2009. The green line on there is yesterday's futures settlement adjusted for the 3-year average basis level. The red line is adjusted for the most positive basis level of the last 3 years, and the blue line is the most negative, adjusted for the most negative basis of the last 3 years. And if you look at it across 2009, we're looking at futures implying an average of about $84 in the fed cattle market. If you look at where I'm at with respect to a forecast, that's in the ballpark of what I think is likely to occur, somewhere in that mid-80s range, which is markedly lower than we've been the last couple of years. The last couple of years, we've seen our average up in the ballpark of about $93. So a dramatic decline coming out of that big decline in beef demand, coming out of the weakness in the U.S. economy and the world economy. Some recovery likely as we head into 2010, but truthfully, I think the biggest chunk of the recovery could wind up getting pushed back to 2011. If you look at feeder cattle prices, using the same approach, using the futures prices adjusted for the average basis level and then the most positive and the most negative basis levels of the last 3 years, gives you some idea as to at least a portion of the risk that's present out there in terms of the forecast. That implies an average in the mid-90s for 2009. If you look at that on an annual average basis, that's a big decline compared to where we were in 2008. I think in 2008 our average was right at about 105. A mid-90s average right around $95 gives us about a $10 decline, and even that's going to be a challenge in terms of returning the cattle feeding industry to profitability. Of course, we've been spilling a tremendous amount of equity in the cattle feeding sector, as Neville pointed out this morning. That's going to continue for a while. One of the ways we're probably going to get out of that, though, is by ratcheting down feeder cattle values to the point where cattle feeders quit bidding all their margins into the feeder cattle. If you look at calf prices, similar kind of a story. Last year, our annual average, a little over 115, about 116 and change. This year's average, somewhere in the vicinity of about 105, 106, 107. So again, another significant decline in those calf prices at a time frame, of course, where our cost of production has been going up and that exacerbates that cost-price squeeze I was talking about at the outset of the Outlook presentation. So, looking forward, let's kind of wrap up with some things here. Looking ahead to the rest of '09, and I think probably spilling into a big chunk of 2010, the weak U.S. economy and the weak world economy is going to have a negative impact on beef demand. As an industry, we're facing the same kind of problems all other consumer industries are facing in the U.S. We're going to have to deal with that and try and find ways to survive through that over the next year and a half or so, maybe a little bit longer than that. If you look at some of the results from our demand study, it's clear that consumers still care about product quality. That means programs like beef quality insurance remain important in terms of maintaining and actually stimulating demand growth in the industry. Food safety is an issue that's been around for a long time, but it is still a very important issue for this industry. We saw in spades what happened in 2007 when we saw that jump in meat product recalls and the big negative impact that had on beef demand. And that's the danger. Whenever you see a jump in those recalls, that's when you really see the negative impacts on beef demand. I think sometimes we get lulled into a little bit of overconfidence when we have a few quarters or a year when we don't have very many recalls and we think it's not so important. And then we see a year like 2007 and it really jumps up and it does a lot of damage to the industry. I think one of the most interesting things that came out of our beef demand study was the fact that consumers really do respond to a positive story about beef. They responded with respect to Atkins. If you look at our results with respect to Atkins, Atkins did have a significant impact on beef demand, maybe not quite as large as I thought at the time in terms of driving that increase that took place in the early part of this decade, but it was clearly significant. And as Ted pointed out with the zinc, iron, protein information, when consumers receive a positive story about beef as it relates to human nutrition, and they receive it over an extended period of time from credible sources, they respond. And I think our challenge as an industry is to build on the success stories we've got, such as the zinc, iron, protein story, identify more of those kind of stories, and get that information out to both consumers and health professionals. Convenience is still very important. And I thought Ted's slide where he talked a little bit about those stock prices, it's interesting. You know, if you're a consumer and you're pulling in your horns and trying to pull back and save money, what's the easiest thing to do, the best thing to do in terms of saving money? Prepare food at home, right? Consumers aren't willing to give up convenience completely, are they? His evidence on McDonald's demonstrates that, right? If you look at the stock prices, they were pulling back from those high-priced restaurants and those high-priced sources of food, but they weren't willing to give up convenience. And I think even though we're in a challenging economic environment, we still have a tremendous number of consumers that care a lot about convenience. And as an industry, we need to remember that. So in our research, it suggests that the lack of new products in the beef arena relative to competing meats, especially poultry, is holding back beef demand. And that's true both at the at-home and at the HRI or the food service level. So going forward, those are some of the key things we think the industry should focus on in terms of improving beef demand, recognizing that in the short run, just because of the weak economic environment, like so many other consumer products, we're going to suffer in 2009 and perhaps in 2010. So with that, we'll kind of wrap it up. I've got some handouts up here on that beef demand study. If you want to grab one of those as you're leaving today, I'd be happy for you to take one of those home. I also have some sign-up sheets for a weekly email newsletter that we have on our AgEcon Extension website, which is agmanager.info. And if you sign up for that, what you'll receive is an email from us late on Fridays that kind of details the new information that's been posted on the website. So with that, I'll open it up for some questions for Dr. Schroeder. Question. Dr. Dykman asked, you know, are we assuming in our demand study here, our demand results, demand forecast, that cool is not going to have any impact essentially on retail beef demand? And in a nutshell, yes. It's not clear to me that that's going to do anything to stimulate consumer demand, despite some of the claims to the contrary. Now, that we're going to get an opportunity to test that to some extent, but I would think that the early evidence would suggest that's the case. It'll be an interesting test, but I see virtually no evidence that suggests that that's actually going to stimulate aggregate demand for beef, and in particular, demand for domestically produced beef. So, Ted, got any other comments on that? Yes. You might want to repeat the question.
Yeah, the question was, what is the number one food safety problem with regard to recalls? And whatever recall happens that day is the worst. I mean, that's the number one, because what happens here is as soon as it happens, we reduce the confidence the consumer has in the product, and it truly decays and chips away, and the person at the grocery store buying the product, if it's on their mind, they're worried about it, if they're taking it home to feed their kids, so whatever. But in terms of prevalence, we're talking here about predominantly Class 1 and Class 2 recalls is what we're looking at. What that means is those that have significant chance of either making someone ill or even worse, okay? So it's not just a product recall because it was mislabeled, but it's a product recall because it actually had a potential health hazard associated with that product. Product recalls, there's a lot of ways to measure, by the way, food safety over time. Product recalls, I would contend, are actually a failure of the food safety system in many ways. Oftentimes, by the time a product recall occurs, the product's already out. We've already had a breach. And a lot of times, that is, the product recall is an after-the-fact thing. Doesn't say don't do the recall. I'm not saying that. All I'm saying is we've already failed. All right, now back to your question. In 2007, the big one was E. coli. 0157H7. That was the one that kept showing up. And if you look at the last 20 years, you just continuously see it. Now, I don't know if 2007 was, some weird set of circumstances that just happened to be that we had a whole bunch in a row. I don't know if that was an aberration or if it was a trend. Clearly, during the 2000 segment, during 2001, 2, 3, we have had more recalls than we used to have, and more of them oftentimes E. coli. Another one that's showing up more often now is Listeria. Campylobacter shows up. So it's predominantly these, and I should let the scientists talk about this. I'm certainly not an expert on the bacteria that are involved here, but it's clearly bacterial types of things that can be introduced at a lot of different places. And that's why, we say it really becomes a very vertical responsibility. Everyone from the 15-year-old who's serving the product off the shelf at the food service restaurant to the rancher down below who has some potential influence on maybe what that animal is shedding or not shedding and how it might shed. So, it really takes a concerted effort. It's not easy, but we have to get to where we increase our vigilance and our ability to quickly arrest and quickly, reduce the presence of those kinds of hazards and events.
Yeah, go ahead. Okay, I'll repeat that. In a nutshell, I think the question was, as the recession continues, will we see an erosion of the premium for choice cattle and choice beef? And I think I didn't show that slide in the outlook for brevity, but if you look at the choice select spread, I think we're seeing some evidence of that right now. I mean, the choice select spread here, 2 weeks ago, was pretty close to zero. I think positive 50 cents, if I remember right. It's climbed back a little bit since then, but not much. And so on a seasonal basis, this is the time of year when we normally see the narrowest choice select spread, and it normally starts to recover about now and maybe peaks later in the spring. So, and we might be seeing that, but it looks like we're seeing it start from much lower levels than what we've seen in recent years, and certainly compared to the 5-year average and compared to last year. So I think the answer to your question is it's already occurred to some extent, and will it continue? I think so. Will some of that product that traditionally or normally doesn't show up in retail grocery stores start to show up? That could be the case. We haven't seen a lot of that happen yet, but we probably will going forward. But it's difficult to capture the same level of premiums at the retail market that you could get, for example, from a Morton Steakhouse. And I think that's going to be the challenge for the industry going forward. And that's one of the things that's going to hurt aggregate beef demand. Not so much that consumers are walking away from the product entirely, but they're shifting down and looking for some cheaper cuts and some cheaper way to consume the product. So. Yeah, in the back.
Where's Rich Schroeder? I saw Rich.
Yeah, the New York Stock Exchange. Well, we got a couple of beef guys here. Well, Gary, you want to do some seminars on that one? Huh? Any other questions? Yeah. Question was, would we comment on the benefits or our appraisal, I guess, of the stimulus program that's been implemented here with the fiscal policy side? And Gary and I were talking about this earlier today. And, I guess I'm a little concerned because as you look at the stimulus program that was just passed by Congress, I really don't see very much in there that from a long-run standpoint is really going to stimulate the U.S. economy. And I think you have to be a little bit concerned about that. If you go back and look at our response to the last really significant or severe recession in this country, which was in the early 1980s, we had a significantly different policy response. Our response at that time was to focus almost entirely on cutting tax rates, with the idea being to put more hands back in consumers' dollars and consumers and let them make some choices, both on the consumption side and on the investment and risk-taking side. And the environment we're in right now seems to be focusing much more on the side of actually raising some tax rates. The good news is not all the way back to the levels that we saw in the 70s, for example, but still, from a directional perspective, I think that's a move in the wrong way. And so, I guess to sum it up, a pretty well-known economist from Harvard had an opinion piece in the Wall Street Journal earlier this week, by the name of Robert Barrow, and the last sentence of his article I thought summed it up pretty well. His comment was, "We will recover from this, but it will be in spite of the government programs as opposed to because of." And I think that's likely to be the scenario, at least based on the preliminary stuff that's taken place so far here in 2009. We will recover from this. It's going to take some time. And, when I think about a rebound in consumer demand, I started off thinking that we might see a rebound in time for the last half of 2010, and that would be reflected, for example, in calf prices in the last half of 2010. I'm starting to think that's too optimistic and that we could easily push this back into 2011. I think it's going to take some time to recover from this, and I don't think we're getting much help from the government policy side. So that's my perspective. Ted, you want to add to that? Or contradict, maybe?
No, I wouldn't disagree with anything that Jim just said. I know we were sitting in here maybe just a little over a year ago, and we had extremely high prices across the board on nearly every commodity we deal with, and now we come back in, and we're sitting on the opposite end of this scale. As an economist, I'm always able to forecast what happened yesterday pretty well, and what I've found out is I'm really, really challenged to forecast much beyond that. But this one looks like it's going to take a little while. This one looks to me like, because of the magnitude of where we've taken dollars from, because it's wealth depreciation here, and it's not just reallocation of resources one place or another, it's actually wealth lost. And that takes a long time to get back. So, for maybe the first time in a long time, I'm more pessimistic than normal. But again, remember that I can forecast yesterday way better than I can tomorrow, and maybe a year from now we can have a happier story. Maybe we all have a different scenario because of how quickly we do see things can change. The best cure for high prices was high prices, right? The best cure for low prices might be low prices, survive it, and coming out the end, as Jim says, wherever it's going to be. I agree, probably 2010 at best, but coming out the end, there's going to be opportunity. And I think that there's going to be opportunity presenting itself in the meantime for those of us or those of you who can position yourself or are positioned well to take advantage of it, right? Anytime you're in an arena where prices are depressed and so is everybody around you, be a little counter-cyclical, you might have an opportunity, but you got to be willing to face that risk if you step in there. But I'm optimistic in that perspective. I think we've dropped prices enough on both commodities as well as some of our assets that we might actually be able to get back and expand in certain areas. So that's just a little bit of my thought.
Thank you very much. We'll turn it back to Larry. Thanks. We appreciate the opportunity. And we've got some fact sheets, and we've got the yellow sheets here as well. Thanks.